I mean, the primary sort of event of the last days is the vol crush, right? Meaning this unbelievable spike in volatility associated with the drop in the equity market, and then an equally impressive bounce, leaving us literally at the midpoint from the high of February 19th, from which we plunged, to the low. We were down 20%. So it's really a jump ball. This is what a pair of twos is, meaning there are big hands where you bet big and you say, I've got an advantage, I go for it. And there are moments where it's best to be small. So this is a small ball moment in general. I think if one's playing XPY and that kind of thing. But we are not going to get resolved anytime soon. We have goalposts almost. The highs of February 19th, the lows of 2 weeks ago were up 13-14% off their lows. And this churning is, I would call it high volatility but low variance. And at the end of the day, it's an opportunity for traders, but you also can get flummoxed and get twisted and get it exactly wrong. Very hard, and yet that's the opportunity.
Yeah, Mike, what have you been seeing?
Yeah, I mean, the first thing I would say is that, the last 2 days, of course, it's not surprising that we see the VIX index down. And we look at the VIX futures, which go out a little bit further in time. We can see that there does seem to be some expectation that we're not going to get back to these prior highs. But we're much closer to the predictions that were being made about prolonged volatility from a week ago than we are anything close to what we saw back on January 21st, right after the inauguration. I think if you take a look at the options markets, what is basically telling you is that we're not done with this by a long sight. And I think that essentially echoes what the Chinese are saying. They're not saying, okay, you can just say, just kidding, and all is well again. We've got a long way to go, I think, before this thing gets sorted out. And I don't think we're going to be seeing the highs we saw earlier this year anytime soon.